Yeah. So we already know impact of capitalization on financial statements. That means when you show the expenses in balance sheet, how it's going to affect the like statements. So we already have seen income statement, capitalization of equipment. That means you are putting the equipment in the asset side of balance sheet, and every year you are expensing that via depreciation. We have discussed 12,000 was the asset value, right? And that has been divided into four equal parts. But in case of expensing, you have put the entire equipment here. Okay. And next coming years, nothing you are incurring as an expense. In this, the entire expense is put in the first year. So first year's performance will be very bad. In this, every year it is scattered. So first year you may see the expenses less, but the coming years the expenses may seem to be high in this case. Okay, when compared to expensing. So like and the balance sheet also, you can see the 12,000 asset will become zero in the final year if you are capitalizing it. 12,000 minus 3,000 first year, then 9 minus 3 6, 6 minus 3 3, 3 minus 3 0. And in expensing, that won't come in the balance sheet at all. It is shown in the income statement. Okay, now based upon the given data only, you need to calculate the ratios and see what is happening. We will not make any hard and fast rule. And also here you have cash flow statement whereby you have operating cash flows, you have investing and financing cash flows, and this closing cash balances are given to you. Okay, this is in case of capitalizing. And in case of expensing also, you have calculated the closing cash balances. Fine. Now we will find out the ratios. So first one is total asset turnover in case of capitalization. What is the formula for total asset turnover ratio? Okay, it is sales by total average total assets. Okay, so we will take the sales and also average total assets every year. Okay, when we take average total assets, we take all the assets. Fine, that is also cash balance also. So we go into the balance sheet. Okay, no need to change this. I have a separate set of page here opened up, so we can calculate. We'll do the calculation. So here we need to calculate total asset turnover. Okay, you can take your calculators and start doing the stuff. So now we will do the calculation part. Okay, total asset turnover. So we want revenue first. So here is the revenue. First we will see the capitalization case. So everything you will get from here itself. That is 30,000. Okay, where we were actually, yeah, that will be 30,000. Whole divided by average total assets. So the first year the assets, in case of we are taking the total assets. Okay, that is 46,300. So we divided 46,300 and you see what's the answer. See, we will take the cash balance also. It's not like only the fixed assets we need to take. They are decreasing, of course, but cash is increasing every year. One of the assets is increasing. We see that in the cash flow statement where we have calculated. See, the cash flow statement is very clear. This cash flow statement closing balances we need to check. It's increasing every year. Fine. So this is 46,300. It is 0.64. So almost they have taken in round figure 0.7. Okay. And then again we need to take 30,000 and then average 30,000. Here the revenue is there second year, and the average asset balance. We will take these two. Okay, 56,300 plus 52,600. Because it is average total assets. So 30,000 divided by 51,250. 0.58, it's coming to 0.6. Okay, so you have to continue and carry on the next coming years also. So see, total assets turnover, okay, we will do for the third year also. Again 30,000, we have 56,200 and 58,900. 55,750. Third year. So 0.53, it almost is 0.5. And you see 0.5 next year also, you can do the calculation. 30,000 divided by this two. So 58,900 plus 65,200 divided by 2. 62,050. Now 30,000 divided by 62,050. 0.48, almost 0.5. Okay. So this is the case. So the total assets turnover ratio is lower if the costs are capitalized due to higher balance sheet assets. Yes, every year your balance sheet assets are increasing. That is because of the cash balances or closing cash balances being more. That day we were only going for asset turnover ratio. We were only focusing on this, but we have to take the total assets turnover ratio. So we need to take the total assets, and total assets are constantly increasing. Okay, because of the cash balances, and we have already made the cash flow statement. You clearly remember about it, right? So here is the cash flow statement: operating cash flow, investing and financing. As you are doing the investment here minus 12,000, and then you have the opening cash balance is nothing and closing cash balance. And next year's what is happening? Next year's there is nothing you are investing or something. And what is happening is every year some cash is getting added up here. Okay, so this like operating, investing and financing is change in cash flow. So this cash flow is getting added up to the closing balance. So your asset is every year increasing, your cash is every year increasing, right? Because next years there is no cash outflow. See, the entire outflow is in the first year. Okay, because you're capitalizing, right? The money is going out. In case of expensing, you are not taking anything in the investing cash flows, because you're not showing that. See, capitalization requires investment equipment to be treated as cash outflow from investing activities, while expensing treats the cost of equipment as cash outflow from operating activities. Okay, so expensing treats the cost of equipment as a outflow from operating activities. Just a second. 8,400. Okay, just a second. Just wait. Just give me a second. Just give me a second. Just give me a second. So like in case of, expensing, the entire cash flow has been taken. The entire investment was taken in case of, income statement. So we didn't show anything in the balance sheet, right? When we kind of expensed it. See, you're not seeing anything here. And we have seen the note also. The note clearly says in case of expensing. So here there is a financing cash flow because the capital has been raised, right? Capitalization. So while expensing treats the cost of equipment as cash outflow from operating activities. We have to check the 8,400 from where they are getting. Just a second. Okay, so this is the case. First year cash is this, second year cash is this. Every year 8,400 wise cash is increasing. See, here you have 40,000 and then next year it is 48,400. We have to check the things here. You have to go to the balance sheet. Okay. So in case of income statement, expensing of equipment, your net income is this. See, whenever you transfer this amount to the retained earnings, okay, there is capitalization spreads the expensing results in full cost of equipment passing through the income statement in the first year, but none in the subsequent years. In turn, this causes net income to be lower in the first year, but higher in the subsequent years. Capitalization results in less volatility of earnings when compared to expensing. That's okay. And expensing, we can check that every year there is a adage of 8,400. Fine. That is clear and evident. So, like the first year, this is the case. Okay. Second year, you start your operating activities with net profit, correct? So your net profit was 8,400, working capital changes, nothing is given. So this only becomes your operating cash flow. So net profit, no adjustment we are doing to this. This itself becomes operating cash flow. So you are seeing operating cash flows. Okay. And that shows that there is a increment of this every year in the closing cash balances and the assets value is increasing. Henceforth, we see something here 40, 48,400, 56,800, 65,200. If the assets in the denominator is increasing, the ratio will definitely decrease. Okay, again you can do the division part. 30,000 is the revenue we'll take for the first year. We will take the cash balances which we have seen. We'll take the balance sheet. Balance sheet. Yeah. So 40,000 plus 40. Okay, sorry, I'm just putting here, right? Okay. So we'll do the calculation part here. 30,000 divided by. I'm doing for the expensing part. Okay. Case of expensing. Just a second. Yeah, so 40,000, 48,400. Do the average. First year it is 30,000 upon 40,000. So you can check it. 0.75 almost I'm getting because I have nothing in previous balance. Okay. So the first year is not exactly matching because I'm taking the total asset turnover, I know there is no property, plant and equipment in case of expensing. See, fine. And the opening balance is here, like, first year I don't have anything to take the average. So 40,000 divided by 1 is 40,000. So I'm getting around 70. They've got 80. And the next year, like, will match 30,000 whole divided by this to average. So 30,000 divided by 44,200, 70% almost I'm getting. Okay. And then next year also 30,000 divided by the average of these two and these two, you'll get the ratios. Okay. Do the calculation part. Net profit margin, what we see every year, net profit by sales. Okay. What is your net profit in case of capitalizing? In case of capitalizing, you know that every year your depreciation was fixed. So we won't see any change. Okay. We don't see any change as usual because every year's net income is same. So this divided by this always will give you 21%. That is done. But in case of expensing, every year you will be, in the first year itself, you will be showing the entire equipment here. So first year will be 0. And the next coming years, you have no expenses. So your ratio will be very high. Okay. So 8,400 divided by 30,000. So almost 28,000 every year. That is calculated. Return on equity capitalization, ROE. So ROE formula is PAT, profit after tax by average total equity. So you can do the calculation part there. Profit after tax is net income. So I'll do the first year thing for you. 6,300 divided by average common equity. So we'll take the equity here, 46,300. Okay. Almost you'll get the ratios in this pattern. Return on equity. Okay. 46,300 divided by 46,300. So 13.6, I'll get 14%. So 6,300 divided by the average of 46,300 plus 52,600. 43,000, 46,300 plus 52,600. 46,300. 51,250. 6,300 divided by 51,250. So 12% almost you'll get. Okay. That is what we can check it, 12 point something. So every year you can see the ratio is decreasing. Why the ratio will decrease is nothing but your incomes are same every year, but your equity, when we average it, okay, we will check it. probably is increasing every year in capitalization. So that's the reason why the ratio will decrease. And here, the first year is 0, and then the ratio will decrease because again the denominator will increase. So this is what we were that day, kind of seeing. And then coming to the next part, this is what we were supposed to discuss. This will be the end of this particular chapter and this exercise. I would like you to go for this exercise, this ratios calculation once again. I'll give you 5 minutes of time. Please calculate. Immediately we'll jump to the next ratios. Okay, fine. Take your time. 5 minutes I'm giving you. Okay, let's go to the next topic. The preceding example demonstrates how the decision to capitalize or expense a cost reduces comparability among companies. Capitalization increases net income. Yes. See what happens when you capitalize certain asset, you put that in the balance sheet and you show very less expense in the income statement. That increases your profitability. Okay, in net income. So we will check that also. See, what is happening? Your net income is increasing in the first year, but in the coming years it is decreasing. In case of expensing, your net income is nothing in the first year, but in the coming years it is increasing. Why? Because the entire expenses has been shown here. Here the expenses have been divided and shown every year, hence you get this figure to see. Here the entire expense has been shown in the first year, so no profit, but here you see higher profits because in coming years there is nothing to see here as an expense. Just a second. Yeah, so we have seen that, and coming to the next explanation, what they have. So and then ROE. See, if your net income is high in the first year, okay, so we will discuss about the ROE in the first year. See, in the first year, when you see in case of capitalizing, your net income was how much in case of capitalizing? It was 6,300 and here nothing, right? So your ROE will be higher in the first year, lower in the coming years. See, because in the coming years, your net income is less here when compared to expensing. And here in expensing, the ROE will be higher in the coming years, but first year it will be lower. See, in expensing it is lower, but coming years it is higher. ROA, return on assets, and ROE other years. So here you see first year higher, coming years lower. Why? Because the profits are less, and this I've explained already. First year lower, coming years higher because of high profitability. So these two ratios are done. Net income first year higher, and lower net income other years. First year if it higher, lower, next year's higher. Okay, so this two is done. And income variability is, here income variability is very lower. Variability is nothing but fluctuations. You see almost, constant income every year. Here first year is nothing, then coming years it is, you are seeing higher incomes, right? So variability is lower, higher. Okay, this is also covered. And assets and equity. See, assets in capitalizing, we have to come to the balance sheet. So in case of assets and equity in capitalizing, see, the assets are increasing, it's higher, right? And in expensing, when we compare, it's lower in the first year. See, they have just told in the beginning years higher, okay, in expensing lower. Okay, so we can see the assets. Okay, you can see, you can draw the comparison. Okay, 56,000, 56,800, and here, it is increasing every year. That is also done. Debt to equity ratio. See what happens. Debt ratio and debt to equity ratio. Debt ratio is debt by total capital. See what happens, your debt by total capital. Where is that debt by total capital? Your debt is how much? In case of capitalizing, we are seeing no debt here. We are just taking there's no debt at all. Okay, and here also there is no debt. In this question there is no data regarding the debt and debt to equity. So debt to equity we will take up. See, we are not seeing any debt here. Okay, what they are trying to say here is, in case of debt to equity, okay, equity will be higher in the coming years. Fine. When we see in the first year, okay, let's say first year, but this data is not given. If they would have given the data, we would have done this, but they haven't given the data. Let me check. Are they telling to consider additional paid in capital as debt? Thing is there. The example considered one of addition to capitalize or expense if a company continues to capitalize rather than expense cost in future periods. The profit enhancing effects of capitalization will continue to provide the capitalized cost in each period exceed depreciation expense. But they haven't given the data, so okay. Cash flow from, see, this data is not given to us. So if I take up a imaginary data also, if I have a data, I can easily prove that debt to total capital. See what happens, debt will be constant. Okay, and in the first year, your equity when compared to the expensing, okay, in capitalizing we'll see what's the case. Okay, let's say in our example, let's say that, okay, but in numerator again I have to take debt. So okay, debt is a constant figure of 10,000, and here also total capital debt is 10,000. Let us see the equity. We will compare the equity in the first year of capitalizing and expensing. Equity, we'll go to the balance sheet. So equity in case of here, in case of capitalizing it is more, and in case of expensing it is less. So this will be, if the denominator is more, it is 46,300, and if I, in case of capitalizing, and if I take in cases of expensing, it is 10,000 divided by 10,000 plus 40,000. You could easily see here it is 56,300, here it is 50,000. Okay, when the denominator is high, the ratio will be less, and here the ratio will be high. Okay, cash flow from operations and cash flow from investing activities, you can check from the cash flow statement, higher and lower. So we will again come to the cash flow. In case of capitalization, closing cash balances. In case of cash flow from operations, okay, it is 9,300, and here it is 8,000. Here nothing you have. So here cash flow from operations is higher in the first year, here it is lower. And cash flow from investments, we have done the investment right here. So here the money has gone out, it will be lower, and here nothing we are showing as investment, it will be higher. Okay, so this is the discussion regarding this particular topic. The entire analyzing from income statements is done. We are done with this chapter. Okay, probably tomorrow I'm going to start equity valuation. So please be ready for the class tomorrow evening and go through this chapter, and I have already sent you the PDF questions to solve. So tomorrow's topic is reading number 46, equity valuation. Be ready. This is a very big chapter. It will take 2 days to finish. Okay. Thank you so much. We'll try to start evening tomorrow somewhat early. I know we have taken less time because if I start a new topic, better to take in a fresh day. Okay. Like, is it okay? Shall we take tomorrow? Please tell. You can work out this. Hello.
Yes, sir.
Okay, then we'll take tomorrow then. Thank you. Good night, all of you.